Hi, Sirshendu. It is a pleasure meeting you.
Hi Nirav, thanks for having me out here.
So, Sirshendu, for those viewing this video, Sirshendu is the head of products at IDFC Mutual Fund, and IDFC Mutual Fund is on its way to launching an extremely differentiated product which will have exposure to US equities. It is called the IDFC US Equity FoF Fund, if I'm not wrong, Sirshendu. Is that right?
Yeah, it's the IDFC US Equity Fund.
Okay. So, Sirshendu, without any further ado, let's ask the most pertinent question that arises in an investor's mind as soon as he thinks about international investing. Is there really a need to diversify beyond India?
Yeah, if you look at diversification, the core requirement for diversification is to enhance the portfolio return. Along with it, reduce the volatility, and both are equally important, right? Now, that's when it is important to have a combination of investments which are low correlated among them, right? And more importantly, they are complementary to each other. That's when we achieve a true diversification and thereby, enhancing our overall portfolio return. So to move towards that step, currently in India, we have options to do it only within an asset class, right? Or asset classes, which within equity and fixed income, right? But if we look at global investors and how they achieve a far better and greater diversification is looking at international market as part of the diversification. And that is a need which we feel that the Indian investors have at this point in time. And our first international offering, through it, we want to help investors achieve a far greater and better diversification. And for that diversification, when we looked at what is the global market which one can look at, after studying all the major markets, we feel that the US markets by far provides the best diversification to an Indian investor. And the reason for that is the US markets are very low correlated to the Indian market. By that I mean when the US market, when the Indian markets are performing not that well, we've seen the US market performing much better and the vice versa. Therefore, when we combine these two strategies, the overall return becomes much better. And we did that, over 3 years. We looked at 3-year, 5-year data and tried to gauge that whether it's truly accretive. It is grossly accretive from a return standpoint, as well as the volatility standpoint. It reduces the portfolio volatility and enhances the return. So therefore, it's a true kind of a friend in the portfolio. Along with that, you may have a question is why US? To kind of elaborate that a bit, US is the largest contributor to the global GDP. To draw parallels, India contributes 3% to the global GDP, whereas US contributes about 24%. So by investing into a market like US, the investors gain access to not only the largest contributor of the global GDP, but also to global revenues. So therefore, making the portfolio truly global and much better diversified.
Right. So, while you were elaborating on the need to diversify, which in my opinion you very well elaborated upon, there was a constant nagging question in my head that I really, really wanted to ask you, and I'm sure even most of our investors have this question. Given the recent run-up in markets globally, especially in the US, don't you think that the US markets are already too heated in terms of valuation, or do you see there's still some more steam left in the US capital markets? What's your view on the valuation standpoint?
Oh, excellent question, Nirav. I mean, this is actually, the core question which we had while looking at this product, and we feel as an investor, one should have this question. So, prima facie, when we talk that the global markets are at an all-time high, and so is the Indian market as well, and the valuation concerns, loom as far as US market. But the point, and it's a very interesting point, when we dig a little deeper to the US market and try to see where is the excess valuation, it's a very interesting statistics which we get. Now let's take S&P 500, which is a diversified US large cap index, and we break it into the top 10 stocks and the balance 490 stocks. Now the top 10 stocks, most of which we are all familiar with, the large names we know about, we use their products, we use their services like your Alphabet, Microsoft, Facebook, and the works. That part of the market is actually a little overvalued. To share numbers, they are about 50%. They're trading at a 50% premium to their 5-year average at this point in time. But the interesting thing is that the life beyond that, or those 10, is where the true delta still remains, which is the balance 490. Now, if I look at those balance 490 stocks and see over there, they are just about 20% higher than their 5-year average valuation. To share numbers, they are currently trading at about 19 times vis-a-vis their 5-year average about or 16 times. So the valuation, which prima facie may look rich, but when we kind of dissect it and try to look at beneath that, it comes to becoming reasonable at this point in time. Now, having said that, a question may come in that why the top 10 being so expensive and still, they are performing well and people are looking up to them. The reason is that the expectation of earning remains very strong over there, and to their and one must admit they are living up to the expectation grossly. I'll cite a couple of examples to you. 2 days back, Google announced its year-on-year results, which were higher by which grew by about 80%. Twitter, which announced its results yesterday, was up by around 70%. Tesla, a couple of days back, announced that they achieved a $1 million profit for the first time. So these are the numbers which are extremely strong, and that is the reason why we feel that the earnings momentum remains extremely strong for even these large companies to sustain some bit of premium to their valuation. So that's point one. The concern for US may also bring in that we are at the historic high. Is it worthwhile to invest? So what we also did is we looked at the data for S&P 500. And why I'm referring to S&P 500 at this point in time, that's a kind of an benchmark for large cap US stocks, right? And we took data from 1988 till June 2021. Now guess what we find? Even if you invest at the highest day or the highest level in any of these years and hold on to your investment, say for 3 years or 5 years, one would have made a return of say 50% for 3 years and around 80% for 5 years. And this is cumulative return. Just leave aside the return numbers, but the moot point here is that on the back of a consistent and strong earnings of the corporates, the return continues to be very strong for the US companies, and that's where the stock performance or the market return also is in tandem to the earnings as well. So therefore, in spite of the markets being at a higher level, we feel that the strong earnings momentum which the companies have, coupled, and a testimony of that is the few I referred to, coupled with that, the overall growth prognosis of the economy. To give an example, US in fact today is the best poised to reopening of the economy and move to normalcy, right? And therefore, the growth momentum is expected to kick in. The current estimate for growth of the US GDP is about 6 to 7% for calendar 21, and that's its highest level in the last 40 years. So therefore, there's a significant pent-up demand which is there. Today, a US investor, is on the verge of coming out or unleashing their pent-up demand, because their current debt, which is the household debt, if I look at, is at the lowest in the last 20 years, And at the same point in time, their net worth is at an all-time high. So you have individual household filled with money bags looking at to to unleash their this demand. So therefore, all of these put together, we feel that the demand and the growth estimates remain pretty strong, and that's what is likely to drive the US markets.
Absolutely agree with you on a variety of pointers here. You spoke about the polarization that exists in the broader US market. So when people refer to US market valuation, in essence, they are looking at the most polarized segment of the broader capital market, wherein the performance has run up quite a bit, obviously. And at the same time, I feel it is extremely critical to view valuation in context of these several developments that you spoke about. One, obviously looking at the polarization. Second, looking at the outlook on earnings recovery, looking at the outlook on a revival in consumption demand in the US, and a whole lot more that you covered, right? So as we move deeper into the US theme, I feel it is time we address the elephant in the room, the IDFC US Equity FoF that IDFC Mutual Fund is launching. So let's talk a little bit more on that. And I feel the most important question is, what is the structure of this FOF? Are you going to be investing in a US index? Are you going to be investing in an international actively managed fund managed by another asset management company? What's the structure? It would help if you could throw some light and color on the structure and the underlying of this particular fund.
Absolutely, Nirav. Thanks for asking that question. The IDFC IDFC US Equity Fund of Fund is a fund which will be investing into an actively managed fund. The fund or the underlying fund is the JP Morgan US Growth Fund. So it's an actively managed US large cap focused growth oriented fund. This fund has was incepted in 2000. So needless to say, it has a very long and strong track record for itself. The focus of the fund is to look at bottom up stock selection. It has a bottom up stock selection process, and the fund is managed by a team which has a deep US market expertise. To just give an arithmetic, the team which manages the fund has a combined experience of over 100 years, and the lead fund manager has been managing this fund since 2004. So therefore, the fund is going to invest into the underlying fund which understands the US market and would be investing into the growth opportunities in the large cap US market. And it has demonstrated, over its period of existence, a consistency in performance, consistency in finding growth opportunity, and it is helmed by a very, very expert team of managers. And what we offer in IDFC for investors is a very, very hassle-free way of investing into this opportunity of JP Morgan US Growth Fund.
Right. So you spoke about a few important elements, and I have been almost itching to ask this next question. I appreciate the kind of management skills that JP Morgan US Growth Fund brings to the table, and I see merit in that. However, on behalf of most of our investor community, I would like to ask this question. Most investors today have the perception that the most effective way to invest in US markets is through index or passive strategies. It is almost as if active investing is dead in the US, and that especially in the large cap segment, it is extremely difficult to find alpha in a market that's as efficient as the US. So what's the scope here for the active fund management to outperform the broader markets or the other competing passive strategies?
Yeah, absolute. Excellent question. In fact, when we were looking at an opportunity in the global markets, and we kind of drill down to the US market, therein we also approached it in the similar manner to look at opportunity wherein we can have a better return in the US large cap space. But guess what? When we evaluated the passive large diversified strategies and also looked at a few actively managed funds, we saw that there are leading funds, and it's not one leading fund, set of leading funds which has been consistently outperforming the benchmark. In fact, 2020 was a very interesting year where we saw more and more actively managed funds were actually beating the benchmark. Now, in this case, if I take the specific example of our underlying fund, which is the JP Morgan US Growth Fund, that fund or this fund has outperformed diversified benchmarks like your S&P 500 or Dow Jones Industrial Average or even the Russell 1000 and 3000 index, anywhere between 5% to 12% over 3-year and 5-year. So we are talking about real outperformance and consistent outperformance over a period of time. So although the kind of a view which an investor may have that in US large cap passives make more sense, but when we delve deeper into that, and we also went with that similar kind of in frame of mind, we were positively surprised, and when we evaluated it further, we felt that from an active standpoint, the JP Morgan US Growth Fund offers significant value and also alpha vis-a-vis the benchmark, and that's why we chose it to offer to the Indian investors.
So very interesting perspectives on active versus passive when it comes to US funds. So while we are on the topic of US funds, I also have another intriguing question that I am sure will be on the top of many investors' mind as soon as they come across the NFO or the new fund offer that you're launching in this segment. See, today the industry is offering a reasonable number of international funds already. Okay, and even within the international segment, there are a good variety, or there is a healthy spread of choices when it comes to US focused funds. So what is differentiated or unique or distinct about IDFC US Equity FoF that will help an investor make a choice vis-a-vis other US focused funds?
No, that's an excellent question, Nirav, I must say. See, the core difference, the way we look at it, is the investment approach of the fund. It is a core bottom-up stock selection of growth-oriented companies. And we have seen in US, when we looked at growth value across large, mid, and small cap, large cap growth, if managed properly, has given the better return or the best return when compared to other part of the markets, and not only superior return but also relatively lower volatility. So that's the ideal mix which we want to look at, and this fund invest into that segment, which is the growth oriented large cap companies. And what it does is it doesn't look at the top 10 stocks only. Rather, currently the fund has a relatively underweight stance on the usual top 10 names. They are there, but they are not the overweight. The overweights are the new companies which have a much higher or greater potential. So that's what is the, I would say, cornerstone for choosing this particular fund out there. And how do we repose confidence in this? Is on the back of the seasoned fund management team, which has been doing this for quite some time. We did touch upon the fact that the fund has been in existence for 20 years. That's pretty long period of time. And it has been able to consistently beat benchmark and also competition. For example, it competes with quite a few of the other, available large cap funds. And hands-on, it has been able to beat, I would say, all the diversified equity fund on one side, right? But that is not only important. Important is that is it able to stand up on the risk metrics? Is it able to protect us, with a lower down capture and a higher up capture, which is up capture means when the market is moving up, is it able to give a higher return than the market up move? And when the market is correcting, is it able to relatively protect, the investment more? In both these parameters, alongside its kind of risk metrics, if I take, like, say, Sharpe ratio for one, it stands very tall on that. So therefore, we feel that this is a very, very strong opportunity from a well-established fund house of global repute, having strong domain expertise into it, and the consistent performance is the testimony of what I am saying.
Thanks a lot, Sirshendu. This has been, truly insightful as a conversation. But before we move towards the close of this session, there is one last question that I have to ask you. How does one go about allocating to this fund? Considering the investor manages his asset allocation between equity, debt, commodities, all of that. So within the equity segment, how much is the right proportion that one needs to allocate, or one can benefit from allocating towards a theme that IDFC US FoF plays upon?
Sure, and that's a very important thing. It's again, with all the positives which is there in the market, it is not a market where we also recommend to put in large or most of the money. It is a diversification investment, right? And we would think about 15 to 20% of allocation towards an international strategy, or a strategy which we are bringing in, which is the IDFC US Equity Fund. This strategy, 15 to 20% in allocation to it, makes it a very reasonable and rational allocation to optimize one's portfolio.
Right. So thanks a lot, Sirshendu. That brings us towards the end of this conversation. I hope most of the questions that most investors would have is captured in this conversation. And guys, if anything has been missed out, write to us at research@fisdom.com, and we will get in touch with the IDFC team, and we will try and share as much insights as possible on this particular fund. So Sirshendu, once again, thanks a lot for your time today. This has been an extremely insightful conversation. We wish you great luck with the NFO. We are confident it will garner a whole lot of investor interest.
Thanks, Nirav, and really love this conversation with you. I hope it is helpful for investors. Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.